Hi and welcome to another video. So last time when I mentioned trading rooms, three videos back, I believe, yeah, I said I would do it in the morning so that you could get to see my live trading, and alas, there is nobody who's around, probably because the majority of my audience is in the US. Nobody's around at that time, 9 to 1 o'clock here in Central European time, because that means 3 until 7 in the morning Eastern Standard Time. So what I thought I would do, because I'm craving that community and just to share while I grind out my my funded account to eventual success in the long term, is because I know my risk profile and it's going to take a long time. I know others can do much better than I can, and I would like to share for free, just to be able to share what I've learned and potentially create something in the future should I be able to provide value. So for now it will be free and I will share the method. So without further ado, I will share the method in this video quickly, and then we'll have a look at some examples, and then if anyone's interested they can come in with, you can drop a comment in the comments section of the comments box of this video and discuss the times and stuff like that you would be available, and then we'll take it from there so that we can capture the most people. If we have 2, 3, 5 people or whatever the case may be, then that would be good to learn in a group environment via TeamViewer, the same room that I use for the morning. So I'll link it again in either the comments section or the description box of this video. Probably the comments section should anyone want to get involved in this, and we will just learn the method together so that hopefully we can create some value for other people. Once again, this because there's a inherent frustration with the speed with which I'm profitable. As you can see on the right here, I lost today, but I am moving in the right direction. It will take time and it's not very glamorous, so in the meantime I just want to share and provide value. So I think I've explained that point enough, so we'll look at the method. It's this simple. Looking for strong, you may have heard in my videos I use these abbreviations. Looking for strong horizontal support resistance, that's HSR, horizontal support resistance, or if you have that's even better, because there are 2 bunches of stops working. Usually the algos will, from what I know, will use the horizontal support and resistances to keep it simple, and then diagonal support resistances are always open to discretion because of the way you can fit the trend line, whereas it's easier mathematically to calculate horizontal than diagonal. So anyway, I digress. So HSR for horizontal support resistance and DSR for diagonal support resistance. We need it to be confirmed by a 5-minute reversal candlestick, RC, followed by a negation of that candle. And then for some reason I've put an asterisk here, so let's see. That's here. So ride the wave of panic, fear, unmet expectations to a discretionary target where the most out of the money stops would be, or when momentum fades for an asymmetrical RR greater than 1 to 1. So what does this mean? I'll show you on the chart, but basically we're looking for asymmetrical, 2, 3, 4 to 1 reward to risk ratio that coincides with a natural place where you would find stops against that failure. So we're looking for a failure of a 5-minute reversal candlestick on support resistance, and then wherever the stops are of the people who were playing that failed 5-minute reversal candlestick. If the momentum fades, then via reversal candlesticks in your trade, then you get out for positive risk to reward. A secondary trade is a sort of inside-out trade where you look for the above, that is a failure of a broken support resistance. You look for the 5-minute reversal candlestick against a support resistance that's already been broken. So that's an outside-in trade. The first scenario is the inside-out So let me explain. So for example, this is an uptrend. You get a reversal let's say you get a reversal candlestick here. Then a negation of that. Natural stops will be found here and here. You trade the failure, so you let the reversal candlestick form. It fails in some fashion via another reversal candlestick, and then you ride it down to the stops. And that's the first scenario, this one. The second scenario is whereby, let's cancel this, whereby you would have a break, however that occurs, and then what was it? Let me pause the video and think, because I've lost my train of thought now. Ah, that's right. So break, come up, reversal candlestick here. So whereas we had the reversal candlestick here, now we have it here. So it should go this way, but it fails. So this time the reversal candlestick would be like this, and then the failure like this in its most simple form. And then it fails, and you go for the stops again. You trade in the opposite direction. When it should have done this, you trade in that direction. And that is all. That is the pattern, and you just have to get good at doing that. So now let's look at where this today hasn't been a good day, hence my loss. Although I could have come out with a gain, it wasn't a good day. The only example that I can see would be right here. So you got horizontal, you've got a combination actually here, but we'll just talk about what we can see on this chart, or maybe we'll go back. Yeah, let's go back. So here you have a high here. I would go here, look at the highest point, the highest close of a reversal candlestick here, so that would be here, and that's my HSR. Then I go across, I see that it broke up from that, so it held, it's respecting, it held once, it broke up from here after a reversal candlestick, held, tried to hold again, but look what happened here on this upsloping DSR. You had a reversal candlestick, a negation via a full red body with higher volume, and then it came back up. You would short here at 57, and then look for stops under here, or choose stops via a measured move, like you measure from here. If that's too far away, and personally I wouldn't have gunned for all the way down here, because that's for 5 tick risk. You would be looking for a 30 tick gain, which is 6 to 1 is too big for this type of play. We're looking for 2 to 4 ish. So you would do something like this. We can see that that doesn't work because that only gets us to 53. So 57 to 53, the risk to reward isn't good. So you would do whatever's necessary to find some form of, the next place I would go to is I would measure from this high, 893, to this low, 854. So that's 39. That means 2 ticks below that, 52, and that's still not good enough. So yeah, then the next thing I would do is look for, where is it? This, because we see we had a slow here, dipped down, came up here and held here. So I would look, this is the beginning of this breakout move here. So I would then measure from here and go 842, 893, that's 51, 5% of 51 is 2.55. So 3 ticks under this low, 39, that would have been my exit. 57 to 39, right here. And as you can see, that's where we held, consolidated, and we've come up to test that now. There were no reversal candlesticks before that time, so you would, unless you counted this as one, either you would get out here for 8 ticks gain for 5 risk, or you would get out at the 39, assuming you stuck to the rules. or possibly here or here, depending on how much of a wick you're looking for. And this is, personally speaking, I would have either got out here at 49 or just held till 39. So yeah, that's a long-winded explanation. I would much rather do it in real time with people and hopefully provide some value. So that's it. I won't extend this video any longer. I'll just throw it out raw. If you're interested in learning this method and seeing how it can work for you, drop me a comment in the comments below this video, and I'll see you in the next video. Bye for now.